Iyer, President and Chief Investment Officer at Debt and Head Products, Kotak Mahindra Asset Management Company, now joins in. Lakshmi, good to have you on board. Many thanks for taking time out. I just want to talk about the elevated crude oil prices and very categorical comments as well coming in from Russia that oil prices could even hit $300 a barrel if the US as well as Europe actually go ahead and ban imports. Does that look quite feasible? Because a lot of countries have, mentioned that they will not be going ahead and doing so.
Hi, good morning. So yes, on the crude oil front, any number which is quoted right now, given that there is so much of uncertainty on the geopolitical front, cannot be discounted at face value. So one needs to, and obviously Russia is one of the biggest, crude suppliers. So I think there is, well, I don't know whether we will, anytime soon reach that number, but the fact that there is no solution as yet in sight is something which the markets definitely are worried about right now.
Yes, indeed. When it comes to the sharp rise as well that we've seen in bond yields, global investors seem to be factoring in some form of a prolonged inflation. Given the fact that we've seen commodities across the board see a sharp rise, what do you think global investors are now pricing in?
So at the current juncture, the mood is such that we have barely started the third month of calendar year 2022, and the foreign portfolio outflows, of course, is predominantly equities. Actually, it's close to a lakh crore, of which about 98 or 1,000 crores is an outflow from equities, and about 2,500 or 1,000 crores is from fixed income. So when there is a lot of uncertainty, typically foreigner mentality is to keep money handy and then obviously take care of it later. That is the current mood. Of course, it also, the next implication is at every level, markets, whether you talk about fixed income markets, for example, the carry is looking attractive. Yes, the rupee has been depreciating, but it has been on a very stable innings for a long period of time. So yes, the fence sitters may still want to wait and watch till they take a decisive call. There are very few in the minority at the current juncture who want to avail of the carry. It's better to have a certain environment rather than come into an uncertain environment.
So whether that's a good...
To add to that, this is also turning out to be a bit of a huge challenge, if I can call it that, for global central banks, including India. I mean, you've got rising inflation, you've got surplus liquidity and geopolitical tensions. Do you think at a time like this, interest rates would be headed higher, or will the Fed also just kick the can down the road?
Clearly, the central bankers world over, and that includes India, are caught between the devil and deep sea. So on the one hand, you are seeing how potentially Ukraine, wheat supplies can be disrupted. And I tweeted about it this morning, how it can have potential impact on the entire season for year 2022. That could stoke food inflation. And on the other hand, look at us, for example, while the current inflation is still docile, obviously the rising crude oil prices have the potential to drop almost 1 percentage point from GDP, because 2021 crude oil average was around $70 and we're already at way beyond 100. It also has implications on current account deficit. All that put together, it is going to be extremely tight-roped. While the Fed is singing a different song, Eurozone is talking a very, very different tune. And then we have India, which is trying to observe all of these. We are in a much better situation at the current juncture, but we cannot be completely isolated. So a tricky one, but one thing is certain, decisively rates cannot go down if interest rates, if inflation is going to remain sticky, which is the case as we speak right now.
That's the other thing that I want to talk about. Since you did talk about India as well, what could be the longer term repercussions if the Indian Central Bank continues to withhold rates in a rising inflationary scenario? Because sooner or later, they will have to move on rates.
The key for this is going to be, or the joker in the pack is going to be the crude oil prices. Of course, gold is also another import item for India. and gold prices also have been on a major sizzle. So I think these two commodity prices, a lot of war premium, a lot of fear and uncertainty premium embedded in gold prices, which is why it's close to about $2,000 dollars plus an ounce as we speak. So I think as policymakers we head into monetary policy the next month, what is going to be critical is what is going to be your assumption. The hope right now is that this war recedes, and obviously bulk of this froth that has got built up into these commodities start easing. Are they going to reach the previous levels just before the war broke out? Very unlikely. But we also need to be mindful that global demand and global growth is getting to be tepid, which means Fed may not be as hawkish as they were probably a fortnight back. So I think there is going to be a lot of these sum of total parts which will actually go into decision making. And mind you, India's headline inflation still is within tolerable limits. It's the core inflation which is sticky, which was the case even a fortnight back or a month back. So I think it's going to be an evolving situation, and that nervousness obviously will not let the markets breathe easily for now.
Lakshmi, good morning. But you know what we're seeing in the currency markets as well, with the way the rupee hit the all-time low, not far from 80, what you're seeing in the bond yields, the impact of that on fixed income products?
We have already seen a significant up move even before this war actually broke out. There was a temporary fear phase when the monetary policy decision was announced, where the yields actually came down after a massive fear-led uptick post-budget. So I think that oscillation, we are close to about 6.9 on the 10-year benchmark. The fixed income strategies have already reflected this in the returns because the yields have gone up, and that has led to a mark-to-market loss on the portfolios. But what is important to note in fixed income is as the yields go higher, it is the carry advantage that starts playing at your investment level. And though the markets are pricing in, or the yield curve has priced in almost 100 basis points of rate hike, incrementally, even if there were to be sharp moves, the impact on the markets may not be very high. So concerns are there, no doubt about it. It's going to be a prolonged earning the carry as a strategy for fixed income investors, predominant part of 2022.
And the commodity inflation that we are seeing, there will be a lot of our viewers who will be looking at what's going on, whether the nickel moved up overnight, that candle, the huge spike, copper, you're seeing with wheat, you're seeing with the agri-commodities. What's your message for all of those who are looking at their fixed income products, who are looking at the equity markets and wondering, is this time to take cash off the table and maybe look at the commodities play?
Rare view driving seldom works in the investment world. So when you have seen so the ones who saw 2021 being a sizzling year for equities, actually saw the past returns and tried to invest, are in for a rude shock. So my one message is please stick to your asset allocation incrementally as yields go up, as the equity markets correct and valuations get more comfortable. Here in fixed income, you have the higher yields playing to your advantage with reasonably high grade sovereign yields, as I said, are so high. It's allowing you to really live your asset allocation and without getting too bogged down by the market's daily volatility. If you stick to your disciplined investment route without timing the market, it's very difficult. All of us know the war will end. When will it end? No one knows. So if you cannot really predict such outcomes, why do you want to control that for your portfolio? So timing is something that we would strongly not really recommend, even in this market. Disciplined, staggered investments should really be the way out.
Right. That's all the time we have today. Lakshmi, it's been an absolute pleasure having you on the show to help us understand the macros and, of course, strategies for all of our viewers. Many thanks.